Are you confused about the difference between your debt to income ratio and your debt to credit ratio? If so, don't worry. In this video, I'll explain the key differences between these two ratios and how they impact your overall financial health. Your debt to income ratio is the total amount of debt payments you owe monthly divided by the total amount of money you earn monthly. This ratio includes all your total recurring monthly debts, including credit card balances, mortgage repayments, car loan repayments, and more. To calculate your DTI ratio, divide your total recurring monthly debt by your gross monthly income. That is the total amount you earn each month before taxes, withholdings, and expenses. So why does your DTI ratio matter? Your DTI ratio doesn't directly impact your credit scores, but it is one factor lenders may consider when deciding whether to approve your loan application. Generally speaking, the lower DTI ratio you have, the less risky you appear to lenders. Be sure to obtain your own independent financial advice. However, the preferred maximum DTI ratio varies. But speaking frankly, for most lenders, 43% is typically the highest DTI ratio a borrower can have and still be approved for a mortgage. Your debt to credit ratio, also called your credit utilization rate, represents the amount of revolving credit you're using divided by the total amount of revolving credit available to you. Revolving credit accounts include things such as credit cards and lines of credit. They don't require a fixed monthly payment, and you can reuse the credit as you pay down your balance. You can determine your debt to credit ratio by dividing the total amount of credit available to you across all your accounts by the total amount of debt on those accounts. Many lenders use credit scoring formulas that take your debt to credit ratio into consideration. In general, lenders like to see debt to credit ratios of 30% or lower. If your ratio is higher, it could signal to lenders that you are a riskier borrower who may have trouble paying back the loan. As a result, your credit score may suffer. Still with me? Okay, good. Let's recap. Your debt to credit ratio refers to the amount you owe compared to the amount of revolving credit available, whereas your debt to income ratio focuses on your debt compared to your monthly income. Familiarizing yourself with both ratios is an advantage, as it gives you a better understanding of your credit situation and helps you anticipate how lenders may view you as you apply for credit. If you have found that these ratios have affected your credit worthiness, don't hesitate to contact us at Credit Repair Solicitors. We specialize in the removal of adverse entries and service Australia-wide. If this information helped you understand DTI and DTC ratios further, please like and subscribe. Also, if you have any thoughts, share them in the comments below.